Hi class, a pleasant day to everyone. This is your Prof. Sir Dan. And in this video, we will continue the discussion on financial analysis and specifically on financial ratio. We have already discussed the four categories of financial ratio. We have already discussed profitability ratio. And now we are going to discuss liquidity ratio. So our topic is about liquidity ratio. Okay? So what is liquidity ratio and what are the types and uses of liquidity ratio? Liquidity ratio is the ability to manage current assets and current liabilities to ensure that assets are adequate to pay its current obligations as they fall due. So under liquidity ratio, we are going to focus the discussions on current assets and current liabilities. Okay? Current assets. It includes cash, accounts receivable, inventory, and other assets that are expected to be liquidated or turned into cash in less than 1 year. And current liabilities, on the other hand, include accounts payable, salaries payable, and current portion of long-term debt and other payables to be paid within the year. Okay? These are the different ways to measure liquidity. The first one is through net working capital. What is net working capital? It is the difference of current assets less current liabilities. Net working capital determines if a company can meet its current obligation with its current assets and how much excess or deficiency if there is. Okay? And the formula for net working capital, it is very simple. You have to get your current assets and you have to deduct the current liabilities from your current assets. And this, you are concerned about the amount of current assets and current liabilities. And you will know that you have a good net working capital if your current assets is higher than current liabilities. Okay? And next ratio on liquidity is current ratio. Current ratio is the proportion of current assets with current liabilities. Current ratio evaluates the ability of a company to pay short-term obligations using current assets. And we are referring to cash, marketable securities, current receivables, and inventory. And the formula for current ratio is current assets over current liabilities. Here you will get the proportion. The standard proportion, meaning the company is in good current ratio if the ratio will be 2 is to 1, meaning for every 1 peso of current liabilities, you have 2 pesos of current assets to pay your current liabilities. Okay? So if your current ratio is higher than 2, then it means that you are above the standard proportion of current ratio. The next is acid test ratio. Acid test ratio is the proportion of quick assets with current liabilities. So here, quick assets. Okay? Quick ratio is also the name code for acid test ratio. So it measures the ability of a company to pay short-term obligations using the more liquid type of current assets or quick assets. So these are the quick assets: cash, marketable securities, and current receivables. In comparison with current ratio, what's the difference? In current ratio, it includes inventory. In acid test ratio or quick ratio, it does not include inventory. Okay? Only cash, marketable securities, and current receivables. So the formula for acid test ratio is quick assets over current liabilities. And the standard proportion for quick ratio is 1 is to 1, meaning you should have at least 1 peso of quick assets to pay your 1 peso current liabilities. Okay? The next liquidity ratio is cash ratio. It is the proportion of cash with current liabilities. Cash ratio measures the ability of a company to pay its current liabilities using cash and marketable securities. Marketable securities are short-term instruments that are as good as cash. So what are the differences of these three ratios? Current ratio, cash, marketable securities, current receivables, and inventory. Asset test ratio, it is cash, marketable securities, and current receivables. It does not include inventory. Cash ratio, it is only cash and marketable securities, okay? And marketable securities are short-term instruments that are as good as cash. So cash ratio, you'll have cash plus marketable securities over current liabilities. Okay? And the proportion, the standard, there's no actually a standard proportion, but it is the acceptable proportion is 0.5 is to 1, meaning for every 1 peso of current liabilities, you should have at least 0.5 or 1 half in your cash to pay the 1 peso. Okay? Now, class, let us do the illustration. Okay, the net working capital, okay, you are going to determine the amount of your net working capital. So with the formula that we have, current assets minus current liabilities, we will be using or needing your balance sheet or statement of financial position. So your current assets is 454,000 in 2018. Okay, and your current liabilities in 2018 is 190. So we will have to deduct 190 from 454 and you will get 264. For 2019, your current assets is 520 and your current liabilities is 270. So the net amount or the net working capital is equivalent to 250. Take note, you have a higher net working capital in 2018 compared with 2019. Okay? The next ratio is current ratio. Here we are going to get the proportion. Okay? And the current ratio formula is current assets over current liabilities, and we need the balance sheet or the statement of financial position. So for 2018, your current assets is 454,000 divided by the current liabilities of 190, you will get 2.39. And you have to express this in proportion. 2.39 is to 1. Okay? So here, you will note that you are higher than 2, so you are doing good. Okay? For 2019, your current assets is 520, and then your current liabilities is 270. So doing the mathematical calculation, you will get 1.93 or 1.93 is to 1. Here, in 2019, you are a little bit below than 2, but you're still okay, but short on this in comparison with the standard proportion. Okay? And now, class, the measurement of good current ratio is the proportion of 2 is to 1. If it is greater than 2, then you are okay. And for the acid test ratio, the standard proportion is 1 is to 1. And acid test ratio, the formula is quick assets over current liabilities. So quick assets consist of cash plus marketable securities plus accounts receivable. So in our balance sheet, cash is 118, accounts receivable is 94. we don't have marketable securities, so we have to add, okay, these two. Okay, so in this case, 212, that is the total of cash on hand and accounts receivable, over the current liabilities of 190. So we will get 1.12, and express that in proportion, 1.12 is to 1. For 2019, okay, our cash on hand is 127, accounts receivable 110, for a total of 237, divided by the current liabilities of 270, and you will get 0.88, or 0.88 is to 1, meaning we are short in 2019. Our acid test ratio is not within the standard, okay? And class, because the measurement of good quick ratio is 1 is to 1. Okay, now the last liquidity ratio is cash ratio, and the proportion is 0.5 is to 1. And if we are going to get the formula, it is cash plus marketable securities over current liabilities. So let's take a look. In the balance sheet, your cash is 118 for 2018. However, we don't have any marketable securities, so we will just plug in 118 over current liabilities of 190. So we will have a cash ratio of 0.622. So our proportion is 0.622 is to 1, which is a little bit higher, or higher than the standard 0.5 is to 1. For 2019, our cash is 127, and our current liabilities is 270. So our cash ratio is 0.47, or 0.47 is to 1. So take note that we are a little short with a standard proportion of 0.5 is to 1. And we are, the performance in 2018 with regards to cash ratio is much better than 2019. Okay, so this 0.47 is lower than the 2018. Okay, so class, there is no actually ideal figure for the measurement of cash ratio, but usually at least 0.5 is to 1 is preferred. Okay, so class, if you have questions, let us know. And enjoy class, the online learning. And if you have questions, please let us know. And stay safe. Have a nice day, class. Stay safe, and we'll see you again. Hear me again in the next video.